For decades, the financial industry has handed retirees a single golden number. It was the bedrock of every retirement plan, the safety net that let you sleep at night, and the mathematical promise that you would not outlive your money. That number was 4%. The 4% rule was simple. Take your total nest egg, withdraw 4% of it in the first year of retirement, and then adjust that dollar amount for inflation every year after. If you did that, history told us you had a 95% chance of your money lasting at least 30 years. But we are not living in the history books anymore. We are facing the economic reality of the mid to late 2020s, and in the context of the 2026 economy, an era defined by fluctuating inflation, erratic bond yields, and valuations that defy gravity, the 4% rule isn't just outdated, it is dangerous. Welcome back. Today we are having a serious conversation about the death of the 4% rule, and more importantly, exactly what you need to replace it with to ensure your financial survival in this new economic cycle. To understand why the rule is breaking, we first have to understand where it came from, because context is everything. The rule was created in 1994 by a financial planner named William Bengen. He looked at market data from 1926 through 1976. He stress-tested portfolios against the Great Depression, the inflationary spikes of the 1970s, and various recessions. His conclusion was that a portfolio split 50-50 between stocks and intermediate-term treasuries would survive a 4% withdrawal rate in worst-case scenarios. Here's the problem. Bengen's data set, while robust for the 20th century, did not account for the specific headwinds we are facing as we approach 2026. The economic environment that allowed the 4% rule to work relied heavily on bond yields that simply do not exist in the same capacity today, and stock market valuations that were, on average, much lower than what we see now. When Bengen wrote his paper, bond yields were significantly higher. You could get a safe return on fixed income that did a lot of the heavy lifting for the portfolio. Today, even as rates have normalized somewhat compared to the zero-interest era of the early 2020s, the real return on bonds, that is your return after inflation, is often negligible or barely positive. If your safe assets aren't growing, your risky assets, your stocks, have to work twice as hard. And that brings us to the second killer of the 4% rule, sequence of returns risk. This is the single biggest threat to a retiree in 2026. Sequence of returns risk is the mathematical reality that the order in which you get your investment return turns matters just as much as the average of those returns. If you retire with $1 million, and the market drops 20% in year one, and you still withdraw your $40,000, you are not just withdrawing 4% anymore. You are withdrawing 5% of a shrinking pot. You are selling assets at a loss to pay your bills. Even if the market roars back 3 years later, it's too late. The capital you needed to participate in that recovery is gone, spent at the grocery store. In the volatile economy projected for 2026, where market corrections are faster and more frequent due to algorithmic trading and global liquidity shifts, a static withdrawal strategy is a recipe for disaster. Recent reports from major institutions like Morningstar and Vanguard have suggested that the new safe withdrawal rate is likely closer to 3.3% or even 3%. That might sound like a small difference, but on a $1 million portfolio, the difference between 4% and 3% is $10,000 a year in income. That is a massive lifestyle cut. So if the 4% rule is dead, what fills the void? You cannot just cross your fingers and hope. You need a dynamic strategy. We're going to look at 3 sophisticated frameworks that professional wealth managers are using right now to navigate the 2026 economy. The first strategy is the Guardrails approach. This was popularized by another financial planner, Jonathan Guyton, and computer scientist William Klinger. Unlike the static 4% rule, which ignores what the market is doing, the Guardrails approach is dynamic. It listens to the market. Here's how it works. You set an initial withdrawal rate, say 4.5%, but you also set guardrails. If your portfolio performs well and your withdrawal rate as a percentage of your remaining balance drops below a certain point, say 3.2 cents, you give yourself a raise. You take out more money because you can afford it. However, and this is crucial, there is a lower guardrail. If the market tanks and your withdrawal rate creates too much drag on the portfolio, rising to say 5.2% of the remaining balance, you are triggered to cut your spending. Usually, this is a trim of about 10%. The beauty of the Guardrails approach for the 2026 economy is that it aligns your spending with reality. It gives you permission to spend more when times are good, ensuring you don't die with millions you never enjoyed, but it also slams the brakes instantly during a downturn, preserving your capital so it can recover. It turns your retirement paycheck into a variable income, much like a commission-based job, rather than a fixed salary. It requires flexibility, but it drastically increases the survival rate of your money. The second strategy we need to discuss is the bucket strategy, or the time-segmented distribution model. This is less about math and more about psychology and logistics, and it is particularly effective when interest rates are volatile. In this model, you do not look at your portfolio as one giant lump sum. You break it into 3 buckets based on time. Bucket number 1 is your now bucket. This holds 2 to 3 years of living expenses in cash or cash equivalents, high yield savings, money market funds, or ultra short-term treasuries. This money is safe. If the stock market crashes tomorrow, you do not care because your grocery money for the next 3 years is already in the bank. You are not forced to sell stocks at a loss. Bucket number 2 is your soon bucket. This is money you will need in years 4 through 10. This is invested in high-quality bonds, dividend aristocrats, and perhaps some conservative REITs. It is designed to grow moderately and refill bucket 1 as you spend it down. Bucket number 3 is your later bucket. This is for 10 years from now and beyond. This is where you keep your growths, your international equities, and your higher risk assets. Because this money won't be touched for a decade, it has time to ride out the volatility of the 2026 market cycles. The bucket strategy kills sequence of returns risk because you are never selling the volatility. You are only ever spending the cash. It separates your liquidity needs from your growth needs. The third strategy, and this is one that many people are hesitant about but need to reconsider, is the floor and upside strategy using modern guaranteed income products. For a long time, annuities were a bad word in the investment community. High fees, opacity, and poor returns. But the landscape has shifted. With the demographic wave of boomers and Gen X retiring, insurance companies have had to innovate. The floor and upside strategy involves calculating your essential, non-negotiable expenses. Mortgage, utilities, food, insurance. You cover these expenses not with stocks, but with guaranteed income sources. Social Security, pensions, and yes, simple income annuities. You build a floor that ensures no matter what the S&P 500 does, the lights stay on and the fridge is full. Once that floor is secured, the rest of your portfolio, your discretionary money for travel, cars, and gifts, can be invested aggressively. Since you don't need that money to survive, you can tolerate higher volatility. You effectively decapitate the risk of poverty. In the 2026 economy, where inflation can erode purchasing power quickly, look for products that offer inflation-adjusted payouts. They are more expensive, but they are the only true hedge against a cost of living crisis. Now, let's talk about the elephant in the room: inflation. The 4% rule assumes a consistent inflation adjustment, but we have learned the hard way that inflation is not a straight line. It comes in waves. In this new economic era, your personal inflation rate matters more than the government's CPI number. If you own your home outright, your inflation rate is lower than someone renting. If you have significant healthcare needs, your inflation rate is higher than the national average. The new retirement strategies require you to stress test your plan against healthcare inflation, which historically runs at double the rate of standard inflation. If your plan assumes 3% inflation for medical costs, you're going to run out of money. You need to model 5% or 6% for that specific slice of your budget. So, how do you combine all of this into an actionable plan for right now? First, abandon the rigid 4% mindset. It creates a false sense of security. Instead, adopt a safe initial withdrawal rate of 3.3% to 3.5% as your baseline. If the market rips higher, great, you can adjust upward. But starting conservative is the only way to safeguard against a poor sequence of returns in the first 5 years. Second, build a cash buffer. Regardless of whether you go full bucket strategy, having 12 to 24 months of cash on hand is the ultimate insurance policy against a market crash. It gives you the psychological fortitude to stay invested when the headlines are screaming panic. Third, be flexible. The retirees who will thrive in the 2026 economy are those who are willing to cut discretionary spending during a downturn. If you are willing to skip the European vacation during a bear market, you can significantly increase your sustainable withdrawal rate during bull markets. Rigidity breaks, flexibility bends, and survives. And finally, look at total return, not just yield. One of the biggest mistakes retirees make is chasing dividends. They buy stocks specifically because they pay a 6% dividend, ignoring that the underlying company is rotting away. In a high interest rate environment, yielding assets can be value traps. Focus on the total picture, capital appreciation plus dividends. You can always manufacture your own dividend by selling a small portion of a growth stock. The death of the 4% rule isn't something to mourn. It is actually a liberation. The 4% rule was a blunt instrument. The strategies we have discussed today, guardrails, buckets, and floor and upside, are precision tools. They allow you to customize your retirement to your specific risk tolerance and your specific life goals. The economy of 2026 is going to be faster, more automated, and perhaps more volatile than what we saw in the quiet decades of the past. But volatility creates opportunity for those who are prepared. Retirement is not about hitting a number and walking away. It is about managing cash flow through an uncertain timeline. By shifting your focus from how much can I withdraw to how flexible is my plan, you shift the power from the market back to you. Don't let a rule from 1994 dictate your future. Run the numbers based on where we are today. Build your guardrails, fill your buckets, and secure your floor. If you found value in this breakdown of modern retirement mechanics, make sure you subscribe, because next week we are going to dive deep into tax loss harvesting strategies, specifically for those in the distribution phase, another crucial tool for preserving your wealth. Thank you for watching. Invest smart, plan for the unexpected, and I'll see you in the next one.